People often like to make trading complicated, but the truth is, there are only a few key concepts you need to master to be able to trade profitably. And in this video, I will put them all together to show you how to build your first trading system. Let's get started. An uptrend is when the market continuously creates peaks higher than the previous ones and bottoms higher than the previous ones. Simply put, every newly formed peak is higher than the previous one, and every new bottom is higher than the previous one. A downtrend is the opposite. The market creates lower bottoms than the previous ones. For example, this bottom is lower than the previous one, and similarly, subsequent peaks are lower than previous ones. Clearly, we want to buy in an uptrend and sell in a downtrend. The third market type is the sideways phase. Sideways is simply when price moves horizontally within a certain range and offers no clear opportunities for either buy or sell. You can recognize it when the market fails to create new peaks or bottoms strong enough. In this example, you can see that every peak and bottom created within this price range is confined by a larger structure. Sideways movement doesn't show a clear direction, so there will be no trades here. In an uptrend, we buy, and in a downtrend, we sell. In price movements like these, there are things called impulse and correction. An impulse is a move in favor of the trend. For example, in an uptrend, strong upward moves are impulses. An impulse is confirmed when the market creates a new peak. Here we have an impulse, then price creates a higher low, followed by another impulse. And because it broke the previous structure to create a new higher high at the end of this leg, that is why this segment is considered an impulse. Every movement in this uptrend is an impulse, because they all create a new peak. The same applies to impulses in a downtrend, when the structure is broken downwards to create a new lower bottom. For instance, at this point, the market broke the previous structure and created a new lower low that is an impulse move. This is the first impulse in the downtrend, and all subsequent movements that break structure are also impulses. For example, when price continues to drop, breaking the previous low and creating a new lower low, that is also an impulse move. The other type of movement is a correction, also known as an adjustment. A correction is simply a pullback. For example, here we have a pullback leg that creates a higher low. That is a correction. All subsequent movements are also considered corrections when price pulls back to form a new peak or bottom. The reason we identify this as a correction rather than an impulse is because these moves do not break any previous structure. Now let's mark this area. We can see price has pulled back from this peak and dropped into this zone. Because price hasn't broken the previous higher low, the market trend remains intact. It is still an uptrend because the market is still making higher highs and higher lows. Therefore, this leg is considered a correction, not an impulse. If the market drops sharply like this and breaks the previous higher low, it is no longer a correction, but becomes a bearish impulse, which is usually a signal leading to a new downtrend. Therefore, when trading, the first thing we need to do is identify which direction the market is moving. For example, if the market is in a downtrend because we see continuous lower lows and lower highs, our goal is to wait for lower highs to appear, meaning these correction legs. And at this pullback, during this correction leg, that is when we look for a sell opportunity at the peak. We want to take advantage of pullbacks like these to enter a sell order, then expect the trade to continue down to create a new bottom. Then, we will incorporate additional factors to identify the profit-taking targets. And I will get to that part shortly. Now let's bring this market structure concept onto a real chart so you can better understand how it works. Initially, the market creates a bottom. Then price pushes up strongly and breaks the previous structure. So because the market has risen and had a break of structure, BOS, we can identify this zone as a higher high. Then the market pulls back to create a higher low and continues to push up to form a new higher high. The reason we focus on this higher high and don't care too much about the previous structure is that this is where the market began to break the old trend. We have the previous higher high at the peak of this candle, and now the market has pushed above that zone, so this becomes the new higher high. Next, price pulls back again from this zone to create another higher low, then continues upward to create a new higher high. Looking at the overall trend structure of this market, this phase is clearly within an uptrend. From this bottom to the top area is an uptrend. Then, from this point forward, the market begins a slight sideways phase, almost within this range. Price doesn't actually go very far in that area, even down to here. because at this time, the market is still holding the price above the previous higher low. The higher low is still here, meaning all movements occurring below this peak, but above that higher low are only considered sideways. But as you can see, after this sideways phase, around this position onwards, the market began to break structure as the previous higher low was breached. That leads the market into an impulse downtrend. This means this will be the first impulse in this bearish trend. Then we have a correction leg pulling back up. Here, the market forms a lower high, then continues to drop to create a new lower low. Then price continues to pull back to create a lower high and drops again to create a new lower low. Those are the two main types of market structure and also the three market phases if we include the sideways part in between. We have an uptrend followed by a sideways phase and then the beginning of a new downtrend. There's an interesting point here. After the market created this bottom, price pulled back up. And looking at the structure we just marked, the market actually broke through some minor structures above. But after that happened, the market continued to drop sharply downward. This is something that occasionally happens in the market. The market can trick you into thinking the structure has broken and the trend has reversed, but then it continues in the larger downtrend. This is simply part of the probability game and cannot be entirely avoided. I just want to show you this so you understand that nothing is perfect in trading. Looking back after this entire movement is complete, we can mark the structure differently. Here is the peak, here is the lower low, followed by the lower high, then the next lower low, then another lower high and lower low here. Next, price pulls back up and makes us think the trend has reversed. But then the market is sold off aggressively to the downside. Of course, there are ways to determine if movements like these are true breaks of structure or just a trap. I've placed a link in the corner of the video. You can watch a detailed lesson on that part. Now, let's continue to expand the market structure analysis a bit more. We see price dropping to break this low and creating a new lower low below. Then the market structure begins to change once again. The lower low is here, and then the market creates a lower high in this zone. And after forming the lower high, the market actually breaks into a new uptrend. This upward push is the start of a new uptrend sequence. Because this is a bullish impulse going from this bottom to this peak, price is now pushed above the previous peak, which brings the market back into an uptrend. And as you see after that moment, the market begins to enter a strong price increase phase following the bullish trend. And this trend continues for quite a long time. So that is the first concept, which is also the core foundation of the market structure. Now we will move to another concept, and this is one of the best tools for finding entry points as well as targets for trades: supply and demand. Here's an example of how supply and demand appear in the market. A supply or demand zone is a sideways region that appears before the market has a strong move up or down. Demand is used for buying, so this zone is a demand zone in an uptrend. Simply put, a sideways zone appearing before a strong upward move will be considered a demand zone. A supply zone works the same way but is located in a falling market. If the market is in a downtrend, we will continue to look for sideways zones appearing before strong downward moves, and those will be our supply zones. Now, to better explain the theory behind supply and demand, we need to look at the market from a value auction perspective. This demand zone lies between the price levels of 1.11224 and 1.11163. This means the price range between these two levels is viewed by the market as a cheap discount price to buy. The reason we know this is because this is where the market previously surged upward. And because the market moves based on buying and selling activity, this strong surge shows that a lot of buying power appeared in that zone. That buying pressure is what caused the market to rise sharply like this. The same applies to the supply zone. That is the price range considered as a high price premium to sell. When the market rises too high, traders will start selling to take profit or short selling because they expect the market to drop. And the fact that the market once went sideways in this zone before dropping sharply tells us that this is a premium price zone to sell. Now let's look at supply and demand from the perspective of demand in an uptrend. Think of it like this. If many large traders and market participants see this price range as a cheap price to buy, isn't it logical that they would continue to buy more when the market returns here? Because for them, this is still a good price to purchase the asset. And that is how supply and demand operate. We can expect that if the market returns to this demand zone, the price will be attractive enough for traders to buy once again, and that will lead the market to continue pushing up in an uptrend. The same is true for the supply zone in a downtrend. We are looking at a premium price zone to sell. You wouldn't want to sell your assets at these low price levels down here, nor would you want to short sell the market there because the price is already too low. Clearly, selling at a high price and buying at a low price is always better. You've probably heard this a lot in trading and investing. Therefore, when using supply and demand, we seek to sell in the premium zone and buy in the discount zone.